This is Matthew Cratter from Trade University, and today I want to talk about how to avoid a crashing stock. I've been getting a bunch of questions about this over the past few days, especially with reference to Zillow and Peloton, which have been having some bad times of their own. So I want to share a saying with you. I can't remember who taught me this, but this is a saying that served me very well over the last 25 years of trading, and that is, most stocks stumble before they fall. What do I mean by this? In order to understand this, we need to look at a chart. We're going to look at a daily chart of Zillow here, and these are daily candlesticks. The blue line is the 50-day moving average. The red line is the 200-day moving average, as we can see up here. And then the bars, the candlesticks, obviously, are the daily price of Zillow. Now, how do we use this? Well, the best time to be long a stock, especially if you're doing multi-day or multi-week swing trading, is when the blue line is above the red line. And even better is if the stock itself is trading above the blue line. So we can see that this was a very good time to be long the stock during this run-up. And one of the things that really initiates this is when you get a moving average crossover and the blue line crosses above the red line. That's called a golden cross. And then we're now going to talk about the opposite of that, which is a death cross. You may have heard of this. This is when the 50-day moving average crosses back below the 200-day moving average. This is when things start to get nasty and when bad things can happen. It's not guaranteed. It can be, you can get a bounce after one of these, but the worst events usually happen after the stock has started to stumble. And now we're in a position to talk about what I mean by that. The first stumble is you get a close below the 50-day moving average. We can see here we got a couple daily closes below the 50-day moving average. It didn't lead to anything. But if you have some big red bars and you close below the 50-day moving average, you have a really sharp sell-off. You have kind of a melt up. We've got a shooting star candlestick up here, and then you get a close below the 50-day moving average. This is when you should start to take notice. And you normally have a little bit of time to get out in a situation like this. We can see even in such a sharp sell-off, going from the 200s here down to the low 100s and closing below the 50-day moving average, we did get sort of a dead cat bounce in Zillow before it started to go lower. So that's the first warning sign. The first canary in the coal mine is a daily close below the 50-day moving average. The second canary in the coal mine, or warning sign, is a close below the 200-day moving average, which happened right here for Zillow. And then finally, the last canary in the coal mine, the last really warning sign, is when the stock not only begins to trade consistently below the 200-day moving average, but then you get a moving average crossover where the 50-day moving average crosses below the 200-day moving average. What's really interesting about this as well, once you get this death cross or 50-day moving average closing below the 200-day moving average, at that point the 200-day moving average really does often begin to serve as resistance. It was support before, now it's resistance, and we can see here that the stock is unable to rally above it. And then it loses the 50-day moving average, and then it's in this context when the stock has already started to stumble that it begins to really fall. So the crash that we got in Zillow a couple days ago, from November 2nd to November 3rd when they report their earnings, there were a lot of warning signs to get out of this stock. The most obvious one is when a stock goes from the upper left-hand side of the chart to the lower right-hand side, upper left-hand side to the lower right-hand side. And then as well, so just even if you know nothing about indicators, you can see that this is a chart of a stock that's going down. But then when you start to use the moving averages, it really gives you some very good warning signs. The biggest one, of course, is the death cross, and then the 200-day moving average starting to serve as resistance. So this is what happened before we got that massive crash a couple days ago. There were all these warning signs, and if you saw them, you probably did not want to be long this stock going into earnings. Now let's look at Peloton to see if we see a similar pattern. We had a very good time to be long Peloton last year after the IPO. For really most of 2020, the stock spent most of its time above the 50-day moving average. Whenever it failed below the 50-day moving average, it had a rapid recovery. And then we began to see some warning signs on the horizon. It began to break down more consistently below the 50-day moving average. And even if you had avoided, if you just traded the stock during this sweet period right here, you avoided a lot of the volatility. You didn't catch the exact top, but you avoided some of this choppiness. So that's one way of dealing with it. But again, we had something very similar, blow off top, a bunch of gaps, some sideways distribution movement, and then we began to have the warning signs happen again. We got the stock close definitively below the 50-day moving average. It tested the 200-day moving average. We got a moving average crossover, a death cross, where the 50-day moving average closed below the 200-day moving average. In this case, the stock was able to, it looked like it was going to be able to trade above the 200-day moving average, and it did. This was a little bit of a fake out, but what we can see here is that the 50-day moving average stayed below the 200-day moving average. And in the most recent weeks, this 50-day moving average, if I zoom in here, we'll see that even the 50-day moving average began to serve as very strong resistance. You can see these tail wicks here where the stock intraday rallied above the even the 200-day moving average, but certainly rallied above the 50-day moving average, the blue line. It was rebuffed and wasn't able to stay above the 50-day moving average for any extended period of time. So this is another case of getting that death cross and then getting some very negative price action, ultimately leading to a very, very nasty gap down on earnings when they were reported a couple days ago in November. But there were these warning signs. There were signs that the stock was meeting resistance at the 50-day moving average, and you already had the death cross. So this is what I mean by stocks stumble before they fall. This crash, this earnings-driven crash, did not come out of nowhere. The market was sniffing out and noticing what was going to happen and sort of anticipating it. And so this is why this strategy works. There's nothing magic about it. But what happens in the world of hedge funds, insiders, now insiders can only buy or sell their stock during certain windows, usually after earnings. But to the extent that you have insider selling, it will drive a stock down. Institutional investors and hedge funds, mutual funds, other types of institutional funds usually figure out what's going wrong or that something is wrong even before the retail investor does. If you're paying close attention to a stock's chart, you can see this in the chart itself. But what a lot of these institutional investors will do, and I know this because I used to be one of them, is that there's sneaky ways of tracking the number of products, for example, that a company is selling. Something like Peloton, for example, you can, what some hedge funds do is they'll buy, in this case, you'll buy many, maybe you buy a new Peloton twice a week and see what the invoice number is or the tracking order number. Or the order number, and use this as a way of sort of guessing how many products they have sold. The companies have gotten smarter about this in recent years. This used to be very easy to do. But obviously you need some money in order to be able to do this, which is why it's mostly an institutional strategy. Not many individual investors can afford to buy one or two Pelotons a week. There are other tracking methods that institutional investors use, like viewing activity from satellites, tracking trucks that are coming and going from the warehouse, maybe even bribing and talking to insiders, though I certainly never knew anyone who did that. And in this process, as these hedge funds, for example, or other institutional investors do this tracking, this will give them the heads up to exit their long positions if they've been long Peloton, for example, since the IPO. And then they'll also short the stock as well. One of the nice things about hedge funds, they're very flexible structures, and they allow you to easily go long and easily go short. And so what happens to a stock when a hedge fund not only exits its long position, but starts to short the stock, thus betting on lower prices? This all provides exiting long positions, entering short positions. It's a lot of selling. This provides downward pressure on the stock. And as a result, you get charts like we've seen with Peloton and Zillow, where the insiders are getting out and also hedge funds are getting out and getting short. In this case, I think I misspoke. Insiders would not be able to sell this close to earnings, but they could, for example, we had the last earnings, they could sell in the few weeks after that, and they could sell into any bounce. But they're not able to sell right before earnings normally. Hedge funds, their hands are not tied in this way. And if they're doing this sort of satellite tracking or advanced tracking of data, they will be exiting their positions and putting pressure on the stock. So this is what I mean. This is why a stock stumbles before it falls, because they're very smart people constantly looking forward and trying to skate to where the puck is going to be rather than where the puck is now. This also applies to stock indices. There was a little event that happened in 2001. I seem to remember that involved some airplanes and some buildings. And we can see here, this is a chart of the S&P 500 in the summer of 2001, and it was rapidly selling off into this event. This event actually was not the beginning of the problems, but really sort of brought everything to fruition in terms of a stock market crash, and then the markets were closed for a week or so. And this happened in the context of a much larger bear market. If you had exited the S&P 500 when you got the death cross back in November of 2000, you would have been fine. You would have been on the sidelines the entire time. Again, I should point out that if you're a long-term investor in a stock, or you're dollar cost averaging into a stock index, or you own a Vanguard fund, or an ETF like the SPY or the QQQs, if you're a long-term investor, these sort of tricks don't really matter to you, and they might actually get you out of an investment when you should not be, when you shouldn't be trading in and out, either for tax efficiency reasons or something else. And so if you're a long-term investor, you should ignore these chart patterns. But these work really well if you are more of a trader, or maybe you have half your money in a trading account, half in a long-term investment account. That's another way to do it. This sort of strategy will work best. And looking for stocks to stumble before they fall, this will work best for multi-day or multi-week swing traders. There is a type of stock that this does not really work with, and those are stocks that have sort of binary outcomes, especially biotech stocks would be in this category, where you have stocks most of whose value is tied to the results of a drug trial. In this case, this was a gene therapy trial that didn't go very well, and the stock fell 50% overnight when the FDA came out and said that the gene therapy trial was not going well. In this case, we can see that the stock was trading above the 50-day moving average. This is Sarepta, SRPT. Before this announcement, the stock was trading above the 50-day and 200-day moving average. Everything was looking pretty good. Then all of a sudden, you had this overnight gap. So this is one risk to trading biotech stocks. You probably shouldn't trade biotech stocks that much. You can be a long-term investor in something like this if you really understand the science behind it, but that's also a very difficult game to play. So we want to stick to stocks that don't really have possibilities of binary outcomes like this, sort of make or break trials or studies for the company, as you get in biotech stocks. If you found this video helpful, you should also check out some of my paid courses. I have a price action trading course where I teach you all about candlesticks, how to trade various candlestick formations, and probably like 20 different lectures in this course. Really cool Japanese candlestick patterns like the 3 black crows, 3 white soldiers, how to identify a double top, various high, low, high patterns as well. If you're just a beginner, check out my course, Learn to Trade Stocks Like a Pro, where if you don't know anything about candlesticks or moving averages, I teach you everything and really take you from A to Z. When you get a little bit more advanced and you get into trading momentum stocks, which I do teach the basics of in these 2 courses, you can check out my 3rd course, which is Momentum Stock Secrets. This is a very advanced course and really takes things to an advanced level. Talks about fractal formations, how to enter a momentum stock that's been going up for a while, for example, how to identify blow-off tops using options prices, and advanced strategies like this. If you join Trader University Premium, you actually get access to all of these courses. You don't need to choose. In addition, you'll get access to my list of favorite momentum stocks. If you stick with the stocks on this chart, you will almost certainly never have a Zillow or Peloton type situation. This is a list of anywhere from 5 to 20 momentum stocks. There's no fixed amount, but I try to keep a list of the strongest stocks in the stock market that make good momentum stocks. And this is really a copy of the pad of paper that I keep on my desk. And so when I have some free time, I want to do a little swing trading or day trading, these are my go-to stocks. So if you join Trader University Premium, you get access to this list as well as all of the courses. I'll put a link in the description notes below right here. You can take a look at all the courses. There's something like 14 or 15 courses included, including my most recent course, which is the Ultimate Guide to Bitcoin, where I teach you how to buy non-KYC, anonymous Bitcoin, and all these other cool things that you can do with Bitcoin. So if this is something that interests you, and you've really been watching my YouTube material, maybe you've read my books, and you want to take things to the next level and enter the paid ecosystem of Trader University, you can click on that link in the description notes below. You can check out these courses. You click on any of these boxes, it'll give you the full list of lectures. I have courses on options, swing trading with options, how to make money with IPOs, learn to trade futures like a pro, etc. This is something that interests you. You can scroll all the way down to the bottom here, click Get It Now. And that'll take you to the checkout page. Now, normally access to everything, all 15 courses, my list of favorite momentum stocks, my list of favorite long-term investments, my Bitcoin course, how to buy Bitcoin anonymously, all of this is available to you for just $125 for 30 days access. But because you've listened to this video all the way to the end, I want to give you a special coupon code where you click down there where it says have a coupon code, type in YT99 as in YouTube 99. Using this coupon code will take $26 off the monthly subscription price, the 30-day subscription price. So you'll only pay $99 to get access to everything, including my list of favorite momentum stocks, really the strongest stocks that are currently in the stock market. So if you've exhausted, as I've said, if you've exhausted all my free material on YouTube and you really want to take your trading and your investing to the next level, I'd encourage you to check out my paid courses by clicking the link in the description notes below. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. Let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.